So we're here with David from ETF Shares. So thanks for coming in, David.
No worries, mate.
So let's start off with you just telling us a little bit about yourself and a bit
Yourself?
about ETF Shares.
Sure. So I'll begin in reverse order. ETF Shares is the first index tracking ETF issuer to launch in Australia in over 10 years. We were founded by a lot of the management team of Global X and ETF Securities, of which I was one member. A bit about me and my background. I started out my career working in London as an RFP analyst for what today is called Wisdom Tree, and I've spent my entire career in one way or another in either journalism, academia, or finance. And yeah, that's a bit about me. A product person by background and within finance, but yeah.
All right.
Perfect.
So I understand your background is pretty unique for a CIA. I mean, you've said you've worked in journalism for ETF Stream and AltFi, covering the industry from the outside.
Yeah.
Now that you are working on the inside, how do you think your previous experience has shaped your investment philosophy now that you are working at ETF Shares?
Yeah, I think having a different set of experiences coming into a role, it actually gives you an advantage. The market, or at least the labour market, is saturated now with people with CFAs, with finance degrees, and all the rest of it. So having a set of experiences and having an educational background that's genuinely different does help you forge a different path. So for me, I've found it very, very useful.
All right. So I noticed you hold a master's in international relations
Yes.
and national security at ANU. Given the current friction between the US and China, something your colleague Cliff Mann has written about in the past, regarding the NVIDIA ban, do you find yourself applying a geopolitical security lens when selecting which markets or sectors to include within your ETFs more or less than a standard analyst might?
I'd say we do it more, and that's a terrific question and well observed, by the way. From our perspective, stock markets, like every market, occur in contexts defined by governments. So if you want to invest in a market, whether it's Australia or whether it's the US, understanding that region's politics is absolutely central. So for instance, I don't think anyone with a good grasp of Russian politics would have invested there 10 years ago, for instance. And, when you understand the politics, you get a better steer on, what are franking credits, how politically robust are they, and why do they matter? What drives bailouts in the US and US military investment policy, which, creates the pipeline of future tech. So yeah, I think it does, shape our investment philosophy somewhat.
Okay. So when you were in Europe, you founded a newsletter called Beyond Beta. Now that you are launching products like the US Quality ETF Best, how do you define smart beta in 2025? Is it still about beating the index, or is it about correcting flaws in how traditional indices like the S&P 500 are built?
That's a terrific question. Smart beta is strictly defined as any type of index that's not market cap weighted. That's a bit of a mouthful for people who aren't specialists in the sector. Is it about beating the index? I would say a lot of the time, yes, it is. And some of them have actually delivered on that, including our own one, at least so far, the US Quality ETF. How do I see various factors? I'm most interested in the quality factor. That's true of Australians across the board, and there's a long established track record there, whether it's active fund managers that we've produced. You guys are probably a bit young to remember someone like Keir Nelson or Hamish Douglas, but they sort of really, blazed the trail there. Warren Buffett did the same thing in the US, and especially his colleague Charlie Munger, the quality approach there. So that's the factor I'm most interested in. And I can keep going if it's of any interest, but we're most interested in free cash flow when defining quality. I think that's a better metric than profit.
Right. Okay. So one of your strongest arguments for your US technology ETF, the WWWW, is that traditional market indices are diluted. You note that under standard GICS classifications, companies like Meta and Alphabet are labeled as communication services and not tech.
Yeah.
Why do you believe these legacy classification systems are failing investors, and is your ETF effectively an arbitrage on this market inefficiency?
We think so, yes. Why are they failing? Historically, believe it or not, companies like Google, Facebook, Netflix, they were included in tech. But what happened was the tech sector then got so big, as defined under GICS, that it got redefined in what was called the defanging. in 2018, FANG being Facebook, Amazon, Netflix, and Google. So, the result is an underallocation from a tech sector investment perspective to those stocks, and we think we are making the most of it.
Perfect. Just moving back to Best
Sure.
a little bit. So, in case of an AI bubble pop, how do you expect Best to behave compared to a more traditionally cap-weighted, ROE-based ETF?
If there is an AI bubble,
Yes.
I don't believe there will be, and I'll come back to that in a second.
Okay.
I would expect Best to underperform
Mm-hmm.
following the collapse of the bubble, at least. Simply because the free cash flow approach lands you in these tech companies very often, because for a number of reasons, that's just where the free cash flow generation is at this stage. It didn't used to be like that. It used to be the oil sector that drove the most free cash flow and the financial services industry back in the day. But now it's software and AI companies that have the most free cash flow. So should that occur, it would underperform. Why I don't think there's an AI bubble. People often misunderstand what happened in 2000 when they saw the tech bubble that emerged. What happened in those years, the late 90s and the early noughties, was a whole bunch of mis-selling from brokers, what are called wirehouses in the US, towards retail investors that's simply illegal today. And that's what drove the valuations up for companies like Cisco, Intel, and all the rest. That simply can't be done in this day and age. So I don't personally see an AI bubble when I look at the valuations on these companies.
Mm-hmm.
And when I look at the history, I think markets are fundamentally different.
With the Australian ETF menu being very crowded,
Mm-hmm.
do you think the future is mainly about fee cuts then,
Mm-hmm.
or it's about giving investors a niche, more specified ETF menu to choose from?
Fees are, in many respects, the first and last thing that ETF investors look at. You could almost make the argument that it's gone too far in this respect, because you can create a low-fee bad ETF and just cut the fee as a distraction, knowing that that's the first thing retail investors' eyes will be drawn to. But it's important that fees are centre of discussion, because fees in funds management compound, and they're charged ongoingly, so every year. So the more money you invest, the bigger the fee you pay, essentially. And as a lot of families are putting their money in these ETFs for decades in some cases, the fee is a very important consideration. So, going forward in product development, it's going to be fee-centred, absolutely, including by us. But I also think there's genuine value that fund managers can provide in giving Australian investors access to things that they couldn't otherwise get. The key example here is bonds. You guys, if you were to start trading bonds, you couldn't. You're not doing it in large enough size. You have to trade in $250,000 chunks for AustraClear to clear your trade. Whereas if you go buy a bond ETF, you can buy for as little as $10. So guys like you, ETFs open up markets that you wouldn't otherwise be able to get, and the fee is just part of the sort of access platform that they're providing.
So I now want to look more towards the future.
Sure.
So ETF issuers are rushing to launch crypto ETFs, but you've said before that you don't see a merit in holding Bitcoin.
Yeah.
So is this a permanent line in the sand for ETF shares to not have crypto ETFs, or?
Yeah, we're no plans anytime soon to launch crypto ETFs. ASIC has said they're only comfortable with Bitcoin and Ethereum ones. It's a bit complicated why that is. It's to do with market making and the availability of hedges for market makers. Bitcoin and Ethereum have more liquid futures, so they're more comfortable with it. But I don't see any merits in holding invest. In Bitcoin, it's there's a lot of evidence of crime there. I don't see an investment thesis.
It's too volatile at the moment, or?
That's the least of its problems, in my opinion. But that's how we see it.
Team argues that big tech must spend billions now to own the future.
Yes.
But if that future is delayed and profits don't appear by 2026, let's say, won't your AI-focused funds suffer massively and drop in value? And how do you protect investors from this specific risk?
I see it sort of like e-commerce. Amazon took a very long time to get profitable. Years and years and years and years and years. And what we saw was a lot of people lost faith. They lost confidence in Amazon over those many, many years because profits hadn't materialized. But when they arrived like a thunderstorm. And Amazon's profitability sort of a wonder to behold. If you look at it, it just only ever seems to go up. And it's been in this wonderful position the past 5 years or so, or 10 years, I should say more accurately, where its highest margin service, AWS, has also been its fastest growing. We think AI is going to play out the same way. You're going to get billions and billions and billions in capex over an extended period of time with a view to killing off the competition and only creating a few winners. That's the way American capitalism works. First, there's the land grab, whether this is in the 19th century around the rails, whether this is in the 20th century during the PC revolution, or whether it's this year with AI. First comes the land grab, and once the winners have grabbed the land, they then start to charge the rent. So we think that's going to continue to play out in AI. ChatGPT, Claude, Gemini, and all the rest of it are all going to try and kill each other. A few winners will emerge in a consolidated market, and they'll start charging rents and making profits very quickly from there. That being said, if investors aren't comfortable investing in a loss-making sector for an extended period of time, don't do it. Don't do something you're not comfortable with, because we often see that the best investors aren't necessarily the smartest people around. They're the people with the best behavioural temperaments. They're the people that have a plan and stick to it. So if you're in a position where you're not fully committed, you're in a position where you don't fully trust the investment that you've got your money in, very uncomfortable place to be. Very uncomfortable. So in that case, probably better off in like an S&P 500 index fund or something like that. Just
So your team identified agentic AI or autonomous software
Yes.
agents as the
Yeah.
top trends for 2026.
That's right.
But currently the market trade is heavily focused on hardware like NVIDIA.
Yep.
And as we move more towards agentic AI, do you expect the value to shift away from chip makers and more onto software layers? And how does ETF Shares plan to capture that specific shift as it happens?
So the way I see NVIDIA is it's like a venture capital company. And when you buy shares in NVIDIA, you're essentially buying shares in the most sophisticated AI venture capital firm in the world, but without the 2 and 20 fee structure. So they invest in all kinds of AI startups, from CoreWeave, which is pretty well known, to Cursor, which is an AI programming company. And so they have a huge amount of operating leverage to this theme that I think people don't appreciate, that extends well beyond their own chip sales. So, yep, we don't think AGI is going to be coming out in 2026 as such. That's probably more 2030 or beyond. That's going to take ages. But when it does, the rewards are going to be phenomenal, quite like they have been for the internet. In terms of concrete technologies that we're going to be focused on, we're interested in quantum computing now as well, and that's Google, where you get these startups in quantum computing like Rigetti that we're not really interested in. But yeah, that will change the map completely and brings us back to Bitcoin. I mean, how does that work if quantum computing can just hack the whole thing? And we're also interested in self-driving cars, especially from Tesla. I'd imagine the up-and-coming generation, so the ones born today, may be in a position where they never need driver's licenses as a result of that. So that's what we're watching.
Amazing. Well, thank you.
Thanks, David.
That's cool. All right, thanks so much, guys. That was pleasant. That was fun.